Now we'll start talking about the profit and loss statement, which can also be called an income statement, which can also be for a nonprofit called a statement of activities. It's all the same thing. It has the same sections. The sections that you'll find there are a section at the top for revenue, and then expenses. Revenue less expenses will equal the profit or the loss. Revenue usually comes first. That's the normal expected way to do it. You would have revenue at the top because that has come in and then you've used it to pay expenses. So you normally put that up top. Some types of revenues that you might have are, of course, grants, and that is an account title that you can use on your profit and loss. You can also use sub-accounts to further break down that account, such as federal and state types of grants. So those would be indented and stated on in two separate amounts on your profit and loss. Your program revenue, you could also have sub-accounts under there too for your various programs. I didn't state any right here. Donations, cash and non-cash, or in kind. You can separate those. So you can see that you could have 20 or 30 very easily accounts for you to categorize your revenue sources too. The expense section of your profit and loss is going to be broken down in a multitude of ways, and this is where you need to decide how you want to communicate this is where you want to decide how to set this up to better communicate to your directors and your board. I've put down one way that you can do this so that you've got salaries and benefits, you've got travel, and then you've got supplies. Supplies may have I put down 2 sub-accounts, custodial supplies and kitchen supplies. Kitchen supplies may be further broken down into 2 sub-accounts for food and non-food items. This is just an example of some ways that you can look at it. And many, many other expenses. It can go on for 2 or 3 pages. Personally, I don't really like to have 2 or 3 pages of breakdown of expenses. I think that's too much to manage from. But your entity needs to set it up the way that you need it. So the total revenue less the total expense is your profit or your loss for the period. I think I might have forgotten to say on a balance sheet, this report is a snapshot in time. This measures your assets and your liabilities and equity as of a certain date, let's say year end, 12/31/20. This is a snapshot in time. A profit and loss measures results of operations for a period of time. So this profit and loss might be from January 1 of 20 to December 31 of 20. This is for a period of time. That's for a certain day. Okay. Now, a profit and loss, and I would encourage you to look into if you don't already. I would encourage you to also use departments. Okay, or you could think of those as classes, I think is what QuickBooks calls them. But departments can further break down your results of operations on a profit and loss. So one department might be maybe your basic grant. So you might have 4 or 5 departments. You could have 6 or 7 departments. One might be the basic grant, so that these expenses that are stated here in your profit and loss could be broken down by basic grant up here. There'd be a column for basic grant expenses. Formula grant expenses in another column. Coming this way, you could have all kinds of columns. You could have food service program in a column. You could have transportation services in another column. All kinds of different departments or grants, that because you have salaries and benefits that apply to many different activities. So you could break those out into those various departments. Again, you set these up how you like. That would work best for the management of your own facility. in connection with your CPA. These accounts that you've set up, the accounts and the sub-accounts, whether the accounts are revenue accounts or expense accounts, asset accounts or liability accounts, those have to be set up in your bookkeeping system under your chart of accounts. Now, your financial officer is going to be familiar with that title. The rest of you may not. The chart of accounts is fluid. You can add and change at any time. So I would just encourage you to set up accounts on your chart of accounts to meet your needs. So these are all examples of accounts you can have and sub-accounts that you can have entered on your chart of accounts. One good practice that you can use so that you know how to categorize your expenses into the correct accounts on your chart of accounts is when you receive an invoice. Let's take, for example, a food invoice from a food service truck. And there are all kinds of supplies that you've received on that. You could maybe have a practice of stamping it with a large stamp that shows different account numbers with the corresponding account names, and break that invoice down right then to the specific accounts that will go to. You've received on that invoice, $1,000 invoice, 500 of it are food items and 500 of it was paper goods for the kitchen. So that stamp that you can stamp that invoice with, you can break it out right there so that then it goes on to your bookkeeper or financial officer and they know how to separate it on the books. So now I'm going to talk about one other expense that you will have on your books that is an interesting, different kind of expense called depreciation. Most of your expenses, you're going to actually write a check, and that's how you know the amount of the expense. But depreciation is a non-cash expense, okay? So you don't write a check for depreciation. Depreciation is an accounting concept. So that when you buy a large item that lives on past 1 year, food is consumed in 1 year. We just expense that. We put that to the profit and loss. But if you were to buy an oven for $10,000 for your center, that's going to last more than 1 year, and it's a large expense. So what you do with that oven is you categorize that to equipment on the balance sheet because it's not an expense, it's an asset of the entity. But that $10,000 oven does decline in value by its nature through the years. So that $10,000 asset, if we want to assign it a useful life of 10 years, we record depreciation on that $1,000 a year. On a straight line method, we would deduct depreciation expenses, $1,000 a year. At the end of 10 years, its value on the balance sheet is now zero. If we bought that piece of equipment and it cost $10,000, let's just record that. We bought it 2 years ago and it cost $10,000. We've recorded each of those 2 years since we bought it $1,000 in depreciation expense. So we now have $2,000 in accumulated depreciation on that oven. So now its net value, $10,000 minus $2,000, is $8,000. It's stated on your financial statement on your balance sheet at a net value of $8,000. It's old. You can't sell it for $10,000 anymore. So we're now stating it at $8,000. It's always estimated. Depreciation isn't an exact science. It's just an estimate of its current value. So that depreciation, if you're taking $1,000 in depreciation expense every year, it's going to be under expenses. You're going to find an account here called depreciation. And in this case, for this year, if you wrote off $1,000 on that oven, you're going to have $1,000 in depreciation expense. Now, no entity has one depreciable item. You've got many on your depreciation schedule. There's a whole list of them, and they all have been purchased at various dates for various costs, and they all have different amounts of depreciation every year, and they all have the total on that schedule will have the accumulated depreciation is going to change every year because we're taking depreciation every year. So that is a separate financial report, your depreciation schedule is, which will back up these numbers on your balance sheet and your income statement, your depreciation expense figure and your asset and accumulated depreciation figure.